Today we're going to be talking about taxation of professional athletes. My name is Rich Hoffman. I work as the Senior Vice President of Tax and CFO Services here at Neil Jasani Advisors. We are a nationwide tax firm specializing in taxation of individuals. When we think about professional athletes, there are really two different ways that they can get paid. They could get paid as a W-2 employee, like you or I as a salaried employee, or they could get paid as an independent contractor. Typically, the salaried employees are members of team sports. Think Major League Baseball, NFL, NHL, etc. The independent contractors are typically individual sports. Think golf, tennis, NASCAR, IndyCar. And the benefits and perks that come with an independent contractor also carry with those people that are performing those individual sports. So let's start with being taxed as an independent contractor. What that means is when you receive your income, you typically receive it as 1099 income. That income can be a direct result of winning a motorsport or a golf event or a tennis event, but it could also come from endorsements. The benefit of being an independent contractor is you can deduct all of your ordinary and necessary expenses, travel expenses, hotel expenses, agents, tax advisors, all of that becomes a deductible expense to you as an independent contractor. Part number two, it also opens up the door for the possibility of using an S corporation to shelter some of your income from the employment taxes. So think Social Security, Medicare. Generally, the benefit of moving your income through an S corporation is about $25,000 for every $1 million that you earn. So for a professional athlete earning 40, 50, $60 million in a year, the benefit of an S corporation becomes significantly larger and larger. As a W-2 employee, a salaried employee, some of the things that you can deduct as an independent contractor, you cannot deduct. Those agency fees, the travel expenses, etc., used to be deductible prior to 2018 with the TCJA, Tax Cuts and Jobs Act of 2018, and the One Big Beautiful Bill recently passed here in 2025. Those costs are no longer going to be deductible for you. Benefit, however, as a W-2 employee is your employer withholds the appropriate amount of tax. And this is where the complexity comes in. The federal tax for professional athletes is relatively straightforward. You get up past $750,000 for a married couple and you're paying at 37%. Relatively easy, but at the state and local level, it becomes significantly more complex. Both as a W-2 and as an independent contractor, you are subject to tax wherever your money is earned. Typically, for professional athletes, these are what are called duty days. So if you are playing a professional sport and you fly into a city not in your state, and you have a day of practice and a day of a game, that's 2 duty days in the state. Your income will be allocated to that state based on the total number of duty days you have during the year and the total number in that particular jurisdiction. So you could be taxed in California, in New York, in Georgia, in Ohio, in Illinois, all of the above during the course of a single year. As a W-2 employee, it becomes significantly easier because your employer simply withholds the right amount of tax for you. As an independent contractor, you need to think about where you're paying those taxes. If you're running it through an S corporation, you are going to be paying tax to multiple jurisdictions, and those jurisdictions can include cities. There are many cities that don't have an income tax except for professional sports. Pittsburgh is one of those cities where you get taxed based on your duty days in that city, and it can be not an insignificant amount of money. So there are other complexities that can come into play. So we talked about duty days. So you play 3 days in Los Angeles, and 3 out of 70 days, 3/70ths of your pay gets allocated to California, and California is going to want their tax. What happens if you have a signing bonus? Ooh, that signing bonus is considered part of your income for the year. And if 3 days worth of time is spent in California, that percentage of your signing bonus will be allocated to California. What happens if you later get cut by the team and you have to repay some of your signing bonus. Well, fortunately, the IRS has a provision for that. Section 1341, it's called a claim of right. You include their signing bonus in income when you receive it, even though it may be later subject to forfeiture. If it is forfeited later, then you get to reverse that income in the year that it is forfeited. There are some complexities to Section 1341. So if you're looking at this as tax advice, I would urge you to pick up the phone and call your tax advisor. There are some good things that can be done with Section 1341 in terms of reversing that income and getting a refund. Along with the duty day conversation, it's very easy to think of your salary and the amount of time you spend in California or New York or Georgia or Illinois and allocate your money across those states. What about endorsements? Are you paid to wear that Nike shirt on the golf course? If so, that endorsement money is going to get paid based on that same allocation. Whenever you wear that Nike shirt on the golf course, that jurisdiction is going to want a piece of that endorsement money. That endorsement money is ordinary income to you, much as your W-2 or your salary or your independent contractor pay is. So also ordinary income, also subject to the claim of a state. Now, if your endorsement is something different, where you're not wearing it during game day, or you're endorsing a product on TV in a commercial, no such allocation. So your domicile in a non-tax state, such as Florida, Texas, Washington State, if you are normally domiciled there, your normal home is there, then that endorsement income might escape state taxation altogether. So speaking of endorsements, there are ways to allocate that income. There are things that you can do in advance of such endorsements. Maybe you have them set up to pay through an S corporation, in which case you may save on the employment taxes, as we've previously discussed. You may set it up in an LLC. There are various reasons you might do that. You don't have to be the 100% owner as the athlete. Your children or your children's trusts could be an owner of that LLC or that S corporation. So when you do get that endorsement pay, that pay gets allocated to somebody else. So you may be taxed at 37%, but that money is outside of your estate and possibly escapes the higher tax that you would typically pay on that income. Other tax planning involving athletes, there are various organizations that allow you to spread compensation over a long period of time. Sometimes we'll refer to that as deferred compensation. Sometimes years or even decades after you've retired from the sport, you're still getting pay. That is still subject to state and federal taxation. However, if you're paid after you've stopped playing, the duty days no longer come into play. So you're going to be taxed wherever your home is. It's a great way to even out your income over a longer period of time and perhaps escape some of the higher taxing regimes. What about international? Increasingly, golf, tennis are played on an international basis. If you are a US citizen and you are playing internationally, there are deductions you can take on your tax return. You are entitled to a foreign tax credit. So if you are paying tax in Ireland and as a US citizen, you are taxed on your global income, you get a credit for the tax you've paid in another country. The opposite is also not true. If you are a resident of another country and you play in the United States, most countries will tax their citizens on earnings in the country. From a US perspective, if you are a citizen of another country playing in the United States, your earnings in the United States are subject to a 30% withholding. So 30% of your earnings will be paid to the US government unless there is a tax treaty upon which we can hang our hat to give you a lower treaty rate. So generally, the complexities of crossing the border and earning money in the United States is daunting. What you ought to do is engage a US CPA firm as a foreign national, engage a US CPA firm to assist you with your US tax filing obligations. One more thing. Athletes are notorious for earning a high amount of money. $50, 60, $70 million for the top performing athletes. How do they save money on taxes? Well, they save money on taxes the way the rest of us do. There are various deductions that can be made. Many athletes set up private foundations. Think of a private foundation as a 501c3 charity that's set up by an individual. It has a charitable purpose. The limits on the amount that you can fund it and deduct are a little bit smaller than a normal 501c3, but you have an immense amount of control. So if you look at the high tier athletes, what you're going to find is you're going to find virtually all of them have their own charitable organization. Not only does it help them to save on income tax, but it allows them to make the world a better place. And it certainly doesn't hurt in terms of notoriety and ability to stay in focus even after they've left their playing days behind. Those charitable organizations live long beyond their playing days. And sometimes that allows them to stay in the spotlight and to get endorsements well into retirement years. So in summary, being a professional athlete certainly has its advantages. It also has its complexities. When you're looking for tax advice as an athlete, you're looking for a firm that has experience across multiple jurisdictions. Certainly, every good tax advisor can help you out with federal tax issues, but it's understanding the local and the state complexities and how they intertwine that really drives the value that an advisor can bring to you. So when you're looking for an advisor, ask intelligent questions. Have you filed taxes in multiple states? Have you worked with athletes before? Do you understand that what might be taxable at the federal level or deductible at the federal level is not always the same at the state level? Ask intelligent questions, find an advisor that you can trust, and stick with them.